So, in this video, I want to talk to you about 2 points, very important. Number one, the importance of tight price action inside a base. And number two, the importance of keeping track of stocks showing tight price action inside the base. Let me repeat what I just said. Two things we have to discuss: the importance of tight price action inside the base, and number two, keeping track of stocks showing tight price action inside the base. Okay, this might sound very similar, both the points, but there is a difference, and I will tell you it's a very vital difference. I will explain to you because this chart of Cochin Shipyard is the best example of what I just mentioned. Okay, so this is Cochin Shipyard weekly time frame chart. This is part number 27 of this multi-part video series. I don't know how many more videos will come in this. I just take it one video at a time. Okay. And I am enjoying this. So, as we know, as per the regulations in India, we have to use old charts. So, I'm looking at a chart of March 2024. Well, 1 year before chart. Okay. Have a look at this base. Now, if you read William O'Neill's book, How to Make Money in Stocks, chapter number 2, how to read and interpret charts. In that chapter, there is a paragraph. Above every paragraph, there is a heading. And that heading says, constructive basing patterns have tight price areas. Something like this. Okay, I may not be 100% right, but he says constructive basing patterns have tight price areas. And in that paragraph, he defines what is a tight price area. Tight price area inside the base means, see, two things. Number one, the closings are very tight, very close to each other, right? Now, if you see the closing price of this candle, this bar, and closing price of this bar, or closing price of this bar and closing price of this bar, it's not tight, right? There is a difference. There is a big percentage difference. But you look at these two bars, this green and this red, that's called tight closing prices. Again, this bar, tight closing prices. This bar, this bar, this bar, this bar, tight closing prices. Look at this, these two, almost the same closing prices. So inside the base, the more tight the closing prices, the better it is. Okay, the lesser is the risk inside the base. Moreover, tight price action also means the fluctuation from high to low is small. Now, if you look at this base, like a flat base, except for this candle, except for this bar, all others have very small spread. Spread means the distance between the high and the low. Okay. So small spread in that bar. Now, there is no definition of big or small. It is all relative. For example, compared to this bar, all the other bars in the base are small. Compared to this bar, these bars are small. Okay, so when I say big or small, I am talking about relatively big, relatively small. So you see relatively small spreads inside the base compared to recent bars like this bar, or this bar, relatively small spread. So remember, constructive basing patterns have tight price areas, and tight price area consists of two things. Number one, small spread, and number two, tight closing prices. Okay, so the distance between two consecutive closing prices is not very large. It's almost the same, right? As we see in this chart. On top of that, if you see volume profile like this, that's a clear sign of institutional accumulation, because when volume inside the base is small, okay, what does that mean? That means the retail players are selling and the institutions are accumulating the stock. Recently, somebody sent me a webinar. Okay, my cousin sent me a webinar, and I was listening to the webinar in which William O'Neill was talking. And he, in that webinar, He says that when you see small spreads inside the base, what does that indicate? It indicates the big institutions trying to accumulate stocks over a number of weeks. So, for example, in that webinar, he says that let's say there is a fund manager with $10 billion uh, as the portfolio to manage, and he decides that out of $10 billion, he wants to allocate 5% to one particular stock. So, what is 5% of $10 billion? Okay, 10% is 1 billion, 5% is half a billion. So, if he wants to put $500 million in one stock, and if he's doing that in a single day, that will naturally push the price up, right? So, the fund managers don't buy all the shares in a single day. They do it over a number of weeks, 3 weeks, 4 weeks, 5 weeks, or during the basing period. And they will buy stocks from whom? They will buy stocks from retail players, right? Because other institutions are not willing to sell their stock. They are holding it for the long term. So they will buy the stock from whom? From the retail people. And you know the supply of shares of stock is limited. So there are only a limited number of shareholders from whom you can snatch the shares. That is why the volume here is low. And there comes a time when the retail supply stops or the overhead supply uh, gets extinguished. What happens after that? After that, the the stock breaks out of the base on higher volume, absorbing the remaining residual overhead supply. See, if you did not understand what I said in the last 2 3 minutes, please rewind and listen to it again and again, because this is very important for you. It is not about the chart. Okay, it is, a lot of people spend a lot of time looking at charts. It is not about charts, it is about understanding what is happening inside the base by looking at price action and volume action. Okay, the green color means higher closing compared to previous week. The red closing means the red color means weaker closing compared to the previous week. Now, if you see here, although the spread is large on that bar, okay, which is not ideal, the spread is large, but it's a bullish bar. Look at the volume on that bar. It is 21 million. What's the average weekly volume? 20 million. So it's a green bar. It has a large spread, but it is closed near the high of the bar. Okay, so having a large spread bar is not necessarily a negative point. Okay, you have to look at price and volume. If the volume is above average and the price is closing near the high, that's a good thing, right? So this is more visible on a candlestick chart than on a bar chart. But if you know how to read charts, even a bar chart is more than enough to suffice. Okay, so coming back to what we were discussing, constructive basing patterns have tight price areas. Tight price areas consist of two things. Number one, tight closings within consecutive 3 4 candles. And by the way, this is marked on the market smith chart by market smith using a cyan color, CYAN color. Okay, let me show you that. Let's see if they have it on the, wait, how do I reduce this? So let's go to market smith. I want to show you the importance of tight price areas. Go to product support. I scroll down. Yeah, see, have a look at this. This is something that you have not noticed. You see these 3 4 weeks very tight closing prices, right? You see this cyan color. I don't know what is the resolution of your monitor, but I hope you can see there is a light cyan color. Nobody even notices that. Okay, people can easily notice the blue color, the red color, the green color, and this moving average and the dotted line and the pattern green line and the blue line and the black line. But do you notice this? You see this tight area, this cyan color, it's there here. Why do they keep it there? Because that it indicates tight price action. Okay, you want that color inside the base. Now here it comes in the green zone, but you want that kind of a color. It's a different color, okay, other than green. I think they call it cyan color. It it represents tight area. So that would be shown somewhere over here. Now, I cannot show you Cochin Shipyard chart on MarketSmith because that will show you the current prices as well. I don't want to do that. But you can go back and check the Cochin Shipyard base. This is called tight price action. So tight price areas consist of two things: tight closing and smaller spreads on the weekly bars. Wait. Yeah. So for now we understood the importance of tight price areas inside the base. Now the next point is very important. The importance of keeping track of a stock which is displaying tight price action inside the base. Now what do I mean by that? Now if you notice here, you see this, what's the closing price of this bar? It's 871.80. Okay. What's the moving average value? It is 876.17. That means the moving average is above the closing price on that bar, which means there is a likelihood that this stock may not show up in our filters. Remember, in our filters, we have one criteria which says price versus the 50-day simple moving average. The price should be above the 50-day simple moving average. Now that blue line here is not the 50-day simple moving average. It is the 10-week simple moving average. Now these are two different indicators, the 10-week simple moving average and the 50-day simple moving average, because they come on different time frames. But in my view, they are equivalent. So for example, if the price is closed below the 10-week simple moving average, there is a good chance that on the daily chart, the price has closed below the 50-day simple moving average. May not happen all the time, but would happen most of the time. That is what I would guess. Okay. So in such cases, just before the stock breaks out, there is a possibility that the stock might not show up on your filtered list. So on Friday, when this bar closes, for Monday, this stock will not be on your list, will not be on your radar, right? But what if it breaks out on Monday, like what happened in this case? Okay, I will show you shortly. But what if it breaks out on Monday, right? You will miss the opportunity, correct? So before that happens, say for example, by Thursday or Wednesday, the stock will come in your watch list. Okay. See, the closing came on Friday, but there is a good chance that Monday, Tuesday, Wednesday, Thursday, the stock was trading above that blue line. So the stock was showing up in your filtered list. This is very important discussion, by the way. So if a stock is showing good characteristics like liquidity, comparative, fundamental, and all those, and it is trading very close to the 10-week simple moving average, just make a note of that stock on a piece of paper. Keep an eye on the stock. It might get removed or neglected by the filter that we have put in, because we are very strict with our filters. But it makes sense to make a note of that stock somewhere, because it is showing good characteristics comparatively, liquidity wise, fundamental wise, etc., etc., etc. Okay. So remember what I told when I started the video: the importance of looking for tight price action inside the base. Constructive basing patterns have tight price areas. And number two, the importance of keeping track of stocks displaying tight price action inside the base. Both are important. Okay. Now this base I would consider as flat base. There's not much of a handle as such here. And by the way, you notice this is a shakeout bar. Shakeout bar is a bar where it takes out the low and then closes back above. That's shakeout is a good sign, by the way. If you have a shakeout inside a base, that means the weaker players are getting shaken out of the stock. So that candle was a shakeout of this bar, which is another good sign. So if I have to talk about the positives of this base, number one, tight closing prices, tight weekly closings. Number two, small spreads in individual bars. Number three, big large spread bar but closing near the high. Very good volume profile, low volume inside the base, and the shakeout. Okay, these are the positives of the base. That is how I would analyze a weekly base. What are the negatives of the base? The negative could be This could probably base number 3 or base number 4. Now I don't remember Cochin Shipyard. What was, I think this was base number 3. Okay. So this could be base 3, base 4, so late stage. Okay, late stage or intermediate, middle stage. Okay, that could be one disadvantage of the base. So we have to weigh the pros and cons and adjust our position size accordingly. So I would consider this as a flat base. This is not much of a handle as such. Normally the handle will have 4 to 5 weekly bars. So if we consider this as a flat base, then the high of this candle, which is 945, becomes our pivot point, right? So let's draw our, so this is 945. Let's draw the pivot range. Sorry, 945. And this is 5% above 945, right? I will take my calculator. Do this exercise on every weekly chart that you consider worth looking at. Okay, 945 multiplied by 1.05, 992.25, 992.25, and let's give it a blue color. Yes, so that's our buying range. Now we'll draw the selling range. Look at the tight price action here. It's a fantastic base. Now let's do the selling range. Green color. This will be 945 multiplied by 1.20. That's 1134. And this will be 25% above the pivot. 945 multiplied by 1.25. That's 1181.25. 1181.25. So that's the selling range. Then we draw the stop loss range. So this will be 945 multiplied by 0.92. That's 869.40. And this will be 5% below. So 945 multiplied by 0.95. That's 897.75. That's it. And we'll give it red color. That's the stop loss range. Now, the stock is not in our watch list, the filtered list, but it is somewhere written in our what do you say, in our notepad. We keep an eye on the stock. Okay. Now look what happens on Monday. See, on Monday itself, the stock enters the buying zone, closes inside the buying zone. So by end of Monday, okay, by end of Monday, the stock comes in our filtered list. Okay, remember that first step, filtering, shortlisting, selection. On Monday, it comes in our filtered list and the price is inside the buying zone. So we have an opportunity to buy after the close of Monday, or if you are smart enough to take notes while you're doing your analysis, you could probably buy it on Monday itself before the closing. Because just because it is out of the filter doesn't mean that you reject the stock, right? Few days ago it was there on your list. So either you buy it on after Monday, after closing of Monday, or if you are smart enough, you could choose to buy it on Monday itself. Look at the volume. Monday itself, you got 11 million volume. What's the average? 12 million. So out of 12 million average weekly volume, if you're getting 11 million on Monday itself, imagine what would happen when the week closes. You still have 4 more days to go: Tuesday, Wednesday, Thursday, Friday. Add another 10 million each. That would be like another 40 million. That the week should close at nearly 50 million with an average weekly volume of 12 million. That's a high volume breakout. Correct? Let's see what happens on Tuesday. So assuming you buy, okay, either on Monday or after the close of Monday, you buy it on Tuesday, because on Tuesday also you would get an opportunity to buy it, right? Because there is sufficient time available to buy. There is sufficient distance here available to buy on Tuesday also, correct? So let's move the price. See, even on Tuesday, it closes inside the blue zone. That means you had an entire Tuesday to accumulate that stock in that range. So you would not have missed the stock. That's what I'm trying to say here. So the more proactive you are in your analysis, the better it is. Wednesday, look what happens on Wednesday. Suddenly goes up. See, in this week, the stock is already up 23% in 3 days. Okay. Next. Next week, Monday itself, the stock is inside the selling zone. So there is a case here to sell half of the position or maybe one third of your position size, whatever you have taken. Let's say you took a position size of 10%. You could choose to sell 3% here, then another 3% when it reaches the high of this selling range. So 3% here, 3% here. The remaining 3-4% could be kept as long as the stock remains above the 10-week simple moving average, right? So if I move the prices forward, the stock continues to go up, correct? So I would prefer to divide my position size into one third, one third, one third. Or if you want to take some money off the table, just sell half. Somewhere here, when it enters the green zone, just sell half and ride the remaining half. As long as the stock remains above this blue line, you ride the trend. So you don't have to micromanage as such. So two big bars here, it went up 24%. Here it went up another 20%. That's the benefit of looking for tight price action. So when William O'Neill writes something in the book, you have to pay attention. Okay. And of course, if you plan to buy 100 shares uh, of of this stock, I believe you should be buying all the 100 shares the moment you get the opportunity, because on Monday itself, the volume came very close to the entire weekly volume. That's called pure high volume breakout. Remember what I mentioned just 2 minutes ago? The week should close near 50 million. Look where it closed. Look here, okay? It closed at 43 million, okay? 43.50, good enough for us, right? At least it's better than 15, 12 million or 15 million, whatever is the weekly average weekly volume. You get my point. Okay. So there is a way that mentally you can extrapolate the possible volume that could show up on the weekly chart. That is why I say if you are trading the weekly charts, you don't need to go to the intraday time frame charts like 15-minute or 5-minute. You don't even need to go to the daily time frame chart. Mentally, you can extrapolate and take position. Depending on the comparative liquidity, fundamental, technical, and market analysis, you would choose to uh, you would decide what position size you would want to get into, and whatever number of shares correspond to that position size, you would buy all of them in one go. Okay, this is an example of that kind of a stock where you don't do pyramiding kind of purchases. You buy everything in one go because the stock is giving you the opportunity to do that. Okay, just to summarize, look for tight price areas inside a base, that's called a constructive base. Look for tight closings inside the base. Look for smaller spreads inside the base. Currently in the market, I cannot show you stocks, but I can tell you that there are many stocks which are near the pivot point, but they have very large spreads. They don't have small spreads, they have large spreads and no tight weekly closings. So I personally stay away from such uh, stocks if at all I am trading the weekly charts. I personally try to take most of my trades on the daily time frame because there you get an early entry. Okay. So I hope this video has been very helpful to you. Watch this video over and over again because I have mentioned many things in this video that are worth listening to 2-3 times. Either you listen to this video 2-3 times or you read William O'Neill's book to understand what I'm talking about in this video. You have to do either of these two. Okay. Thank you so much.